Hey there, everyone. Dave Keller here with Market Misbehavior, President and Chief Strategist of Sierra Alpha Research. And thank you so much for joining me here on my weekly show on Stockcharts TV. Today, folks, we have got to talk about the Magnificent Seven, or I should say Magnificent in air quotes, Seven, and friends, those leading mega cap growth stocks that were so dominant in 2024. Really, I think one of the key stories, if not the key story of the equity markets in 2024 was the dominance of the Magnificent Seven names, those leading growth stocks continuing to compound their gains, continuing to go up and to the right, and with such a big weight in the benchmarks that the S&P and the NASDAQ were propelled higher in no small part because of those strengths in those names. 2025 proving to be a very different year so far from the Magnificent Seven, and arguably this is no longer a homogeneous group of leading growth names. It's now a couple disparate groups, a couple groups of stocks showing some similar characteristics, but with less and less similarities between all of them. You're really starting to differentiate the names that are still working, of which I would argue there are only 3 left, and then everything else. So today we're going to talk about the performance of the Magnificent Seven. We're going to dig a little bit into 3 different buckets within this group of 8 leading mega cap growth stocks. Talk about some of the weaknesses we're seeing in some of them, some of the unknowns. I think Alphabet is still very much an open question kind of chart, but it features a bearish divergence between price and momentum. So we'll finish off showing some other charts showing a similar bearish momentum divergence, which I would argue is a key market theme, certainly a key technical theme to be following here in February of 2025. With that in mind, let's look at the performance of the Magnificent Seven stocks year to date. Short answer is it's not great. So this is a performance chart, and I love using the sharp charts on Stockcharts and using them to gauge performance. There are a lot of great performance capabilities that are actually built into the sharp charts platform now. Here what I can do is look at the performance of MAGs and then just start to enter other ETFs, other indexes which I want to compare performance to. And I can see that the MAGs ETF, which granted is not perfect. I mean, it's an ETF that holds a lot of these names and the weightings are sort of interesting, but I would say that ETF, which really is as close as you can come up with a direct play on the Magnificent Seven stocks, up 0.4%, and actually briefly on Friday went net negative year to date. The NASDAQ 100, the S&P 500, and the equal-weighted S&P 500 are all up about 3 to 3.5% in the first 5 weeks of 2025. By the way, I know this is not a video on gold, and I do own the GLD, full disclosure, but I just want to keep reminding people, don't forget about gold. Precious metals often get a bad rap. They're thought of as a safe haven. It's one of those, if stocks struggle, then I'll start to play gold. Gold led the S&P and the NASDAQ through most of 2024. And so far, early days of 2025, continuing to outperform just fine. But let's get back to some of those mega cap growth stocks. What I like to do when I'm looking at a group of names like this, put them on a chart list number 1, and that's this previous chart list. This is chart 1, and then I also have all the other charts together. But I wanted to look at them individually for this video just to sort of break out, find some comparisons. And I love the fact that you can take a list, a chart list in Stockcharts, decide how you want the different buckets. So here I'm actually just sketching out patterns and writing tickers based on which charts are similar. And then I like to reorder my chart list using the numbering system to group the similar charts together. That way I can follow some of those emerging themes and see how much different stocks that I group together, see how much they actually perform in very similar fashions going forward. So the first bucket, I would say the long and strong, consistent outperformers. These are the stocks that look a lot like the Magnificent Seven did in most of 2024. They're continuing to be strong in early 2025. I see no real technical issues with these charts, and overall they're continuing to do quite well. Meta is the obvious outlier here, continuing to make a pattern of higher highs and higher lows, currently sitting above 2 upward sloping moving averages. Look at the relative strength, which is just lights out strong over the last 6 months. The RSI extremely overbought, which is actually quite bullish. What that means is you probably get a bit of a pullback. When the RSI hits 80, you often get a bit of a pullback, but it usually means we're going to get at least one more move higher, one more significant move to the upside. We used to call this the good overbought. because when the RSI is above 80, that doesn't just mean a short-term pullback. It often means a short-term pullback within the context of much further upside strength that we still haven't experienced yet. So Meta is one of those. The other two, I don't know if you come up with them, is Netflix. Netflix is marked by the fact that a couple weeks ago we had a gap higher on their earnings report, and then we continued to go higher. This is what I call a gap and run pattern. You had the initial gap. We traded into the close a little bit lower, down to around $950. This is after hitting $1,000. We came down to around $950, and it looked a bit of a concern, looked like a concerning pattern there, on day one post earnings, because we were trading lower after the gap. So it gave that impression that investors were thrilled to cash out after a big jump higher in price. But if you look in the weeks after that earnings report, we've reinitiated the uptrend, showing that investors are willing to pay more than $1,000 a share for Netflix. So I think that's a pretty impressive one as well. Finally, Amazon. Amazon's actually pulling back in the last week or so, but still remains above two upward sloping moving averages. The RSI making the price making higher highs and higher lows. The RSI is strong but not excessive in the relative strength, still trending higher. Now, one concern on the chart of Amazon is a potential bearish momentum divergence. Higher highs in price, lower peaks in momentum. Put a pin in that idea, because we're going to come back to that when we talk about Alphabet and look at some other names also showing that bearish momentum divergence. But those three stocks, Meta, Netflix, Amazon, I would say now differentiating themselves in that they are showing strength, while a lot of the other Magnificent Seven names are showing quite a bit of weakness in some cases. The second bucket would be these stocks that I would say are now broken charts. Now, to be clear, these are short-term broken charts, right? Tesla is down from around 480 to around 350. That is not a small number, but we're still way above where we were 6 months ago, 12 months ago. We're still overall much higher than we were. But in terms of the technical configuration, we can see that there are a lot of things to be concerned about. With a stock like Tesla, things that concern me in the recent 3 to 5 weeks, a pullback to support, a failure to hold support. That's what happened over the last week, as we broke below that 380 level, which had served as support for the early days of 2025, now broke into the downside over the last week. We went from going above an upward sloping 50-day moving average to breaking below. After gapping lower about a week ago, we've continued to sell off, and that deterioration in price is now driving the momentum into a more bearish range. In a bullish range, the whole range of the RSI, or in a bullish trend, the whole range of the RSI will often drift higher. In a bearish phase, the whole range drifts lower, and when the RSI goes below 40, that often indicates we're now in a bearish range. What you need to look for with a chart like Tesla, by the way, is that next rally. We'll have a rally at some point, at the very least some short-term bounce, and what you want to look for is see if the RSI is able to regain 60, see if we're able to make a new swing high above 440, but if neither of those things happen, I would argue the chart of Tesla now in a primary downtrend. Apple also has made a lower high after undercutting its own 50-day moving average. We can see the bounce in late January up to retest the 50-day. We have this big bearish candle where we opened around 247, closed down toward 237, and then continued to drift lower over the remaining week. Now, Apple's an interesting one because it's actually testing a monster support level. If you look at the early November low around 220, you can see the mid-January low around 220, and that's where the 200-day moving average is now. Apple's been above its 200-day moving average since early May, when we gapped up and then continued to drift higher. Overall, I would say this is a concerning development if it's able to break the 200-day moving average to the downside. That would be a very broken chart after the RSI stalled out at 50 on that rally in late January. Microsoft is another one that just looks like a jumble of price action over the last year. Really, at best, a sideways trend here. You can see that where we're at right now is literally exactly where we were 12 months ago in February of 2024. The last 12 months have been a big nothing burger from a technical perspective. We've been going up, we've been going down. Arguably, this is part of a large sort of topping pattern. I mean, if you look at the last 2 years, it almost looks like this big extended head and shoulders top kind of pattern. Still very clear support down here at the April and August 24 lows. That's around 385, 390. But I would say looking at the last year, just kind of zooming in a little bit, those are those swing lows here. I would say in the short term, we're just range bound. And that's the problem for the chart of Microsoft. Really just hasn't been going up in quite some time. NVIDIA is the last one. NVIDIA obviously gapped lower a couple weeks ago. This was the DeepSeek AI news out of China. Came out over the weekend. The gap lower for NVIDIA, and a lot of the other semiconductors gapped down as well. I would say NVIDIA, I actually hesitated to put it into an question mark bucket because it's rallied up into the gap range, which I think is important. It's worth noting from a technical perspective, by the way, we gapped lower. And then on that gap day, and this was, again, the Monday after the DeepSeek AI announcement came out over the weekend. This was the Monday sort of downgrade when all these stocks gapped down and NVIDIA's down 20-some%. But then if you look, we really have remained within the range of that gap day for the next 2 weeks. And then just on Friday and then today, we've broken above the upper end of that gap days range. We're now trading back within this consolidation area. So I would say the general trend is still probably negative here. But overall, I like the short-term bounce that we're seeing so far in February. That's something certainly to watch. With NVIDIA, by the way, what stands out from a technical perspective, all these bearish candle patterns, bearish engulfing patterns at a lot of these tests of major highs. You can see this has happened actually so many times. It's almost like a joke, right? It's a running joke that you have these bearish engulfing patterns that happen at major peaks. So I would keep an eye on NVIDIA for sure because bearish engulfing patterns have been frequent and fairly successful at identifying some short-term pullback stocks. So that second bucket of names, I would argue, are still are broken charts, right? And in the short term, you're certainly seeing distribution as opposed to accumulation. And besides NVIDIA, which is starting to trade a bit higher here in February, starting to regain some of that downside gap after the DeepSeek AI news, I would say this entire bucket has questionable strength. Also notice, by the way, on NVIDIA, this bearish momentum divergence that you see in October and November going into that test of $150, which with subsequent tests failing as well, we saw the weaker momentum characteristics going into that peak, and that was a telling sign of a major top. Now that leaves one more name, Alphabet, which is kind of an interesting one because we gapped a lower last week on earnings. It's continued to trade lower since then. Friday in particular was a big down day, closing below the 50-day moving average for the first time since Thanksgiving of last year. I would say still an open question as to whether we get more of a breakdown here, but generally, obviously, when you compare Meta, Amazon, Netflix, these are stocks kind of still in an uptrend. Alphabet now has to, at the very least, be in a different bucket of stocks that are gapping lower on earnings. So I think it looks a lot more like an NVIDIA, maybe an Apple with some of a pullback after a major peak. One more time, note the bearish momentum divergences. So I made a point of highlighting some of these divergences. In a minute, I'll show you some other stocks showing divergences as well. One of the check boxes on my market top checklist is a proliferation of bearish momentum divergences. I'll show you some of those charts and why they're a concern. Before I do that, though, I just want to remind you two quick things. Number one, if you're looking for my market recap show, it is alive and well. It's called Chart This with Dave Keller. We run it every weekday, every trading day after the close. We run it at 5 p.m. Eastern, 2 p.m. Pacific, and it's on my YouTube channel. And there's a link in the description below to access the playlist of that live market recap. You can tune in here on YouTube, but also on X, on Facebook, on where else do I do it? Facebook, LinkedIn, X, and YouTube. So any of those platforms, if you follow me on those social media outlets, you will see an alert for that live stream. You can always watch it on my YouTube channel called Market Misbehavior. Also, I have a Market Misbehavior podcast, which I launched toward the end of last year, where I think 24 or 25 episodes in, some really fantastic conversations recently with Jay Hatfield of Infrastructure Capital Advisors. Steve Kress of Seeking Alpha. Hopefully we'll get that episode out in the next day or so. I had a really good conversation with him at the end of last week. Who else? A bunch of other really interesting interviews over the last couple weeks. Peter Bookvar, that is, of a fellow CNBC contributor, sat down with him as well. Some great conversations about overall market conditions, about the Fed, earnings, all the macro conditions, combining the back with the technical conditions that you and I follow very, very closely. So you can follow all of those things, the Market Misbehavior podcast and my market recap show, Chart This, on my YouTube channel. All right, let's go back then to Alphabet. And as I was saying before that little break, I think the concern with Alphabet and with a number of other charts, Amazon and others, or what we call a bearish momentum divergence. This is a classic technical pattern where you have the price going higher on weaker momentum. So higher prices, lower RSI. Because what happens is during a healthy bullish trend, you have an expansion in momentum, or at least strong momentum. So when we rally and when we make new highs, we become overbought because there's such a strong upside momentum. As long as that pattern continues, the uptrend is in good shape. But when you start to see new price highs, on weaker momentum, that's called a bearish momentum divergence. Often happens at the end of a bullish trend. And while you don't know exactly whether there will be a gap or just a rollover or whatever, or even if there will be a top to be had, generally, when I see those bearish divergences, that tells me we're in the fourth quarter of the uptrend, not the first quarter of the uptrend, right? Or in baseball terms, we're in the eighth or ninth inning, not the second or third inning. It doesn't guarantee that we can't go to extra innings and continue an uptrend a little bit longer, but it does tell me we're most likely near the end of the game. So what other charts are showing these? Well, Decker's is one that I highlighted on my market recap show on Monday, February 10th, because of these highs on weaker momentum. Looks a lot like the chart of Alphabet, actually. And I think this is a concern now going into February, is into earnings. You had some charts that actually looked quite strong. I mean, the chart of Decker's was lights out positive until late January, when we finally made those new highs above 215, 220 on weaker momentum. Look at the downward sloping momentum. We then gapped lower on that end of January earnings report, and now continuing to go lower after the gap. So that actually starts to look like a what's called a breakaway gap or an initiation gap, where you have the big gap down, and then we continue to see distribution, showing that investors weren't thrilled to buy Decker's at a $45 discount from one day to the next. They were continuing to sell. Not a lot of motivated buyers coming in, and as a result, we've seen further downside. Synchrony Financial, some of the other financial stocks that have been in really good uptrends over the last 3 months. Financials have been the top performing sector year to date in 2025 as of last Friday's close. So some really good charts in there from the money center banks, some of the regional banks, and others. The problem I have with SYF, bearish momentum divergence. November, December, January higher peaks, with the most recent high just above $70 on weaker momentum all through that period. So again, while Synchrony hasn't broken down, and I would need to see a break below 63 to clear the way below those recent swing lows, the fact that we're making new highs on weaker momentum has me a bit concerned. And it's not just CYF. We can see on the shorter term Citigroup, SYF that is, Citigroup making higher highs into February, the RSI starting to slope downwards. Oracle, to bring up another technology name, and again, this is the danger of what can happen with some of these bearish divergences. Oracle in early December of last year looked remarkably strong. Higher highs, but all of a sudden weaker momentum, particularly with the December peak coming with an RSI right around 60. Then we had the gap lower on earnings. Then we continued to drift lower. Now all of a sudden it's been chopping around, and a bit of an unclear scenario after an island reversal and a bunch of other things. But that peak was really punctuated going into the peak by the bearish divergences. So what concerns me here as I'm taking assessment of the markets is while the S&P and the NASDAQ are not too far off of all-time highs, while the S&P is still within, a rounding error in some ways of its all-time high around 6,100, we're seeing some concerning developments underneath the hood. Number one, we're seeing the mega cap Magnificent 7 names look less magnificent, right? We're seeing only 3 out of those 8 charts as I went through it, I would say clearly in an uptrend at this point. You have a couple showing divergences, maybe beginning to break down. We have some earnings misses on stocks like Amazon and Alphabet causing some downward trends. And then we have names like Apple and Tesla, which are just flat out broken, right? Sort of no longer going up and starting to test some real key support levels. So while the long-term trends are not broken on any of those charts necessarily, the short-term trends are certainly very different. It's very much a change of character, and at the very least, I would say a leadership rotation. So I'm skeptical as to how much the major benchmarks can go up without that group of stocks, the Magnificent 7, leading the way. We're also noticing some of those bearish momentum divergences, and we highlighted some of those in technology names, in financial names, in consumer names, and those are just a handful of the ones that I've identified just here in the last 24, 48 hours. There are a bunch of other ones as well. On my market top checklist, which is something I review regularly with my market misbehavior premium members, we look at whether we see an expansion or a proliferation of bearish momentum divergences, because at previous major tops, that is often one of those last signs during the bullish phase. You see a bunch of things still going up, but on weaker momentum characteristics. For now, I'm keeping a watchful eye on some of those support levels we talked about. On the S&P itself, it's 5850 remains my line in the sand, but the signs of deterioration from the Magnificent 7, the downside momentum turns, creating these bearish momentum divergences on some of the charts that we talked about, have me skeptical of meaningful upside until we see a change in some of those technical charts. What do you think about those ones? Any divergences that I missed or anything you would disagree with in some of the ways that I describe these charts? Make sure you drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me here on Stockcharts TV. And remember, it's always a good time to own good charts. Have a good night.